We live?
We are live.
Hey, what's going on, folks? It is 6:57. We're just getting ready for our Paradigm Shift podcast. We'll start our curriculum, technical analysis of financial markets, Tech Tuesday. Start that at around 7 o'clock. So stay with us. I'm glad that you've joined us on the various social media forms that you're here on. So today we're going to talk about some pioneers. We're going to talk about Charles Dow, right? Okay. So just give us a couple minutes and we'll be right back with you. Paradigm Shift Podcast.
So we have 2 minutes till we're actually considered live.
Mm-hmm.
So during this time, you're welcome to talk to us. We're welcome to talk to you.
Okay.
Is he on Facebook?
No, he's not on Facebook Live. So for anybody who's watching, they can enjoy behind the scenes.
Behind the scenes
Yes.
at the Academy.
So it's okay.
So we need to take these
Practice.
cups off?
Yeah. So you can't see anything on this side, just so you know. You want this?
Yeah.
Okay. But you can't see anything past this
Okay.
board. Yeah.
Yeah, he's live on Facebook.
Okay.
Yeah, he's
Let me
live.
refresh it. Oh, he's live from Dr. Haynes' page. He's not
Yeah.
live from his page. Okay.
Yeah.
So I'll go share.
Okay. And then from the Dow theory, we'll go, hold on, let's see. Dow theory. And we'll go right from here to here and talk about the Dow theory, right? So how does the Dow theory work?
So we won't give a countdown. We're ready to go live.
Give me a countdown, getting ready to go live. We playing.
All right. So we're going to officially go live in 5, 4, 3, 2, 2.
Ho! Good evening, folks. Welcome to the Paradigm Shift Podcast, hosted in Buffalo, New York by Dr. Curtis Haynes, Jr. Today's podcast is called Tech Tuesday, where we look at the stock market and we look at the various tools that we use in like forecasting in the stock market. Okay, so everybody, let me just introduce myself. My name is Curtis Haynes. My title is Dr. Curtis Haynes. I have a doctorate degree in economics, and I've been studying political economy for close to 40 years, and I've been studying finance, particularly personal finance, for about 20 years. Right now, these particular Paradigm Shift podcasts are built around the idea of economic and financial literacy. We have 4 podcasts. The first is Physical Friday. We did that last Friday, and that's where we did a karate class, Physical Friday, and that was the idea of what we're working with is the concept of life wealth and material wealth. So the karate class was the life wealth, and today we're talking a little bit about material wealth. So the first thing we're going to talk about, we got financial terms of the day. Something that's real interesting. It's called the Rule of 72. Right? And so the Rule of 72 is kind of like a thing that people use. And the idea is that it's a way to determine how long an investment will take to double given a fixed annual rate of interest or rate of return. So if you divide 72 by the annual rate of return, an investor would be able to obtain a rough estimate of how many years it would take for the initial investment to duplicate itself. So if you look at this table right here, you have rates of return in the first column, you have rule of 72 in the second column, and then the actual using the present value data, right? These are the actual years that it would actually take. And what you would notice, and then this fourth column shows the difference between the rule of 72 and the actual number of years. So if you had a 2% return on your investment, it would take 36 years for you to pretty much double your investment, okay? If you had a 3% return, it would take 24 years. And what we're doing, we're dividing 72 by 2%, we're dividing 72 by 3%, that'll give you 24. If you're able to get a 5% return, right, it'll take about 14 years to double your investment. If you had a 7% return, it'd take about 10 years, 9%, about 8 years. And these are over here in the third column, these would be the actual number of years, right? If it was 12% return, it would take 6 years, right? 25% return, almost 3 years. 50% return, 1.4 years, etc. So those of you who just want to think about, like when you're looking at your long-term investment, and think about if you have something like, say for example, you have a defined contribution plan that gives you a 5% return, right? Well, it's going to take you 14 and a half years to double your investment. Okay, so that's the concept of the day, the financial concept of the day, the rule of 72. All right, so check it out. Again, just something to be aware of. Now, what we're doing here, this podcast is, again, it's a economic and financial literacy theme, right? And this particular one, we're looking at the relationship between trading and investing in financial markets. The particular discipline in Technical Tuesday or Tech Tuesday is technical analysis. And what technical analysis is about is using charts and figures to follow price and volume movement in financial markets, right? What kind of financial markets? And if you participated in our Tech Tuesday last month, right? And again, Tech Tuesday is in the spring and in the fall, right, is going to be the second Tuesday of every month. So our next Tech Tuesday will be the second Tuesday of May. And then we'll be off for the summer and we'll be coming back in the fall, okay? But what we did talk about in the last podcast, Tech Tuesday podcast, we talked about what securities were. And we'll be doing that again, all right? But right now, all right, we're just going to assume that you know a little bit about that, and we're going to look at the idea of looking at charts and figures to follow price movements, right? So if you have a security like, a lot of you have Apple products. So the price of a stock, an Apple stock, it goes up, it goes down, and a lot of the retail and the professionals use technical analysis to follow that movement, okay? You could use it to follow movements in option markets. You could use it to follow movements in cryptocurrency markets. And so we're using historical data, right? And also, as we get to the end of this podcast, we'll talk a little bit about current events using the newspaper Investor Business Daily. And why is this important? If you see right here, if those of you who've been participating in my workshops, my personal finance workshops, these concepts is that you have financial habits, and most of us I myself, when I was a high school student, my financial habit, if you look right here, my financial habit was the financial habits of the poor, right? Money would come in and I would just spend it, right? When I got my first job, my first real job teaching, career job, teaching at Buffalo State College, or Buffalo State University currently, right? My job, my salary increased, and then I started buying these liabilities, and I really wasn't paying attention to my asset column. And what I realized and what I learned, right, and I think it was I studied Robert Kiyosaki's, when his book, Rich Dad, Poor Dad came into my life, I really became, even though I was an economist, I became aware of these different financial habits, right? If this is your financial habit, money coming in, money going out, if you have this habit for the next 40 years, you're going to be in a very difficult situation because you won't have any kind of assets in your asset column. If you want to retire, you're not going to be able to retire because you're going to need some assets that can generate income for you. The American dream was that you get more money, you get that job, you get that salary, and you get the house with the white picket fence, 2-car garage, a dog, a couple of kids. Right? But the principle was that generally the American dream was for the American middle income class, which was typically working class, people who work for money. And so, but sometimes, like if you think about it during the pandemic, the Great Recession of 2008, and any of the recessionary environments over the past 100 years, right? People lost their jobs, and the middle class dream turned into the middle class nightmare, because with the loss of the job, you still had your liabilities, but because those of us working class, we were never really taught to build up our asset columns. There was no assets. The financial habits of the rich pretty much is you take a portion of your earned income, take a portion of your income, and you build up your asset column, right? So this particular podcast is discussing, right, how do we go about building this asset column, looking particularly at stocks in the stock market, okay? So again, it's a trading discipline that is employed to evaluate investments and identify trading opportunities. One thing they say about technical analysis is that it doesn't really tell you what to buy, but it can tell you when to buy, or it can tell you when to sell. That's the big advantage of technical analysis. It's used to employ and evaluate very, very different financial instruments and identify trading opportunities, looking at price trends, price patterns that can be seen on charts. And you see I have my whiteboard back here. I'll talk a little bit about those price trends and those price charts. Now also, if you have any questions that you want to ask me while I'm giving this presentation, we got to ask my production team, and they'll pass those questions on to me. One thing about technical analysis is that the idea is that the past, it may not repeat itself, but like some people say, it typically rhymes, right? So past trading activity, past movements in markets, they can give us some kind of perception with regard to what, maybe even forecast what's going on into the future. Also, my last technical analysis course in March, we talked about the efficient price hypothesis, meaning that some people would say that past data doesn't describe what could happen in the future, and is not really a good tool for forecasting the future. But that being said, you look at any of the talking heads on the key CNBC, CNN, and what have you. Any of Bloomberg TV, right? They do look at technical analysis, and they use that to a certain extent to forecast. Now remember, it's not a crystal ball. It's just one of the tools in this vast repertoire, right? One of this vast repertoire of tools to study the financial markets. So in sum, right, technical analysis is a method of analyzing and predicting stock movements based on past market data, primarily looking at price and volume data. Okay, so what we're going to do today is we're going to look at the pioneers of technical, one particular pioneer. So on the various podcasts over as we move forward, I will focus on pioneers. Today's pioneer, technical analysis wouldn't be technical analysis with this man named Charles Dow, right? And Charles Dow, he was the first one to introduce the Dow Jones Industrial Index, right? And he was the founder of the Wall Street Journal, right? So Charles Dow, this is Charles Dow. He's born in 1851, died in 1902, and he founded the Wall Street Journal. And that became the benchmark of all financial papers are measured. Now, I personally, we use the Investor Business Daily, but the Wall Street Journal is also a very powerful newspaper, and it's the grandfather, it's the original one. He also created the Dow Jones Industrial Index, and with his discussion of the Dow Jones Industrial Index, he opened up the door to technical analysis. And what he did is he recorded the highs and lows of his average, right, the Dow Jones Industrial Index, right, on a daily basis, on a weekly basis, and a monthly basis. And he saw that there were patterns, right, that went with the ebb and the flow of the market. And he would write his articles recognizing those patterns. And so Dow theory, a theory of financial markets, and the theory actively consists of 6 core tenets developed by Charles Dow. All right, so we're going to go to the internet here. Let's see here. Okay, so I'm at the Investopedia.com, and those of you, right, like part of what's significant about studying finance, you're going to have to carry your own water, right? Okay, you're going to, if you really want to get good at something, you're going to have to put the time in, right? And so Investopedia is a free website. And it's like an encyclopedia. It has a lot of stuff. So right now, what we're going to talk about is how the Dow theory works. And there's 6 main components of Dow theory. So the first one, the Dow theory operates on, which states that asset prices incorporate all the available information, and that the market discounts everything, right? So earning potentials, competitive advantage, that which we know, right? That which would, rumor, what have you, right? When we look at prices in the market, right? Those prices explain pretty much what is going on, both what is known to the broader public and what's known behind closed doors. Okay. So first tenet, market discounts everything. Second one, there are 3 primary kinds of market trends, right? So the market experiences primary trends which can last a year or more, such as a bull market or a bear market. And then within these broader trends, there are secondary trends that make up smaller movements, such as pullbacks within a bull market or a rally within a bear market, okay? And these secondary trends can last a few weeks, a few months, and then you have minor trends that can last a few days or a few weeks. Let's see here, accumulation phase, public sector. So let's take a look at this, right? So So what I'm going to do in terms of, so you could have an idea of what a trend is. So I'm going to put it on the whiteboard. So right here, if we, let's see if I go here, right, and come across here, right, and I put on the horizontal axis time, T-I-M-E, right, and then we could say the price, in this case here we'll use the dollar sign, of a particular security. All right, so like we could use this as APL, I believe that's the ticker symbol for the Apple stock, right? And so when we talk about trends, right, is that you have, it's kind of like it goes, right, boom, 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 right? That's an uptrend, okay? And right now I got 1, 2, 3, I have 4, right? But generally what happens in the market, right, is that this first phase, so we'll call this number 1, right? Like those of you who heard me talk, right? There's people who follow the market and those people who make the market, right? So when it trends up, right, like along this lines here, right? This is kind of what you would see as a bull market, right? Okay. As it trends up, right? This first is kind of like, you think of a bandwagon, right? And you got people who, you got the musicians on the bandwagon, and they beating the drums, and they're like, "Hey, everybody, get on board, right?" So this is the accumulation phase, right? The accumulation phase is like generally the first phase of the market, the first phase of a bull market, and generally that phase is highly influenced by the market makers, the ones who actually make the market happen. And they're the ones who are going to start accumulating, like if this was Apple, they will be accumulating a significant amount of Apple stock, right? And they're the ones who pretty much make the market work, right? And then what happens, right, is that they start accumulating, and then other people start coming in, right? Other people start coming in, right? And then you have this next run right here, right? And this is kind of what we call the intermediate phase, right? And this is where the public starts getting involved, right? And so the word gets out, right? Because generally, like even if we talk about what's going on right now, right? Even if we talk about what's going on right now, we've been in a bear market from like November of 2021, and so 2022, it was real rough for a lot of people, right? But now we're in 2023, and in 2023, right, it appears that this is what's happened so far, right? Now it may be what they call a bear trap, right, or a bull trap, right? But right now it does appear that we're going through an accumulation phase, and generally during this time period, the public is still have the trauma of the bear market, right? So a lot of people in the public, they don't want to participate. They're still thinking about, well, is there going to be a recession, right? But those people who make the market happen, pretty much they're making this market happen. So then, once the public gets get over their fear, then they start participating, then they come into the market. And so what you see is that we have higher lows, right? So this is a low, this is a higher low, this is a higher low, this is a higher low. And then you also have higher highs, a higher high, a higher high, a higher high. But what's really important is these higher lows, okay? And then what happens is that as this bull market goes from like a baby bull to a full-grown bull, right? Going through this process here, where the price, like if this price is, let's say it's $50, price goes all the way up to $150, right? As the general public become more aware of it, right, the general public starts getting involved. And generally what would happen is you get to the excess phase. So that, like this excess phase, like either here or either here, right? Those phases are when, that's kind of like when everybody is saying, you need to buy some stock, right? You need to get in, and then people get in not by doing their own work, but they get in because somebody recommended that they get into the market, okay? So again, the three phases, right, of a bull market, typically, right, is that you have the accumulation phase, and now I was giving the example of the bandwagon phase. So now you got the bandwagon, they're already on board, right? So they're telling, they drumming up sales, right? They're getting people to buy. Because if you think about it, right, like in the market, for every purchase, there's a sale. For every bid, there's an ask, right? So if they've accumulated a lot of securities at this low price, right? They start distributing that accumulation, trying to get a capital gains. They get a capital gains, right? Then they may pull back, buy some more, get some more capital gains. So all this, they're going to distribute along the way as this market is going up. They're going to distribute it, okay? And then what happens, right, if you think, again, going back to the idea of the bandwagon, right, they get everybody, I got my Mac is about to die right here too, 10 minutes, okay? But if the bandwagon is going up, right, or, they got more and more people coming onto the bandwagon, by the time we get up here, this is pretty much the retail crowd. This is the crowd that really doesn't know anything. These are the speculators. These are the people who have FOMO, fear of missing out, right? And then they get in, and generally they get crushed, right? So the significance of and it typically happens. I remember it happening to myself, right? I remember that as a, I wasn't really, I think about it in the dot-com era, right? I was not paying attention. I was kind of like, again, I wasn't really paying attention to the stock market. I was a state employee. I was working on the, I was working as a college professor, and I had one of my students in 1999. He was telling me, "Hey Doc, you need to get into this market, right?" And I was like, "No, I'm not really interested in it." And he had bought some penny stock that was at a nickel at the time he was telling it to me. I think it was like in the fall of '99, and then in the let's say it was September. Then in October, November, it went from a nickel up to about 50 cents. Then it went from 50 cents to $1. It went from $1 to $5, and it reached $5. And I was starting to pay attention, right? And so again, you have the accumulation phase. It's going up here. It's like I'm starting to pay attention, right? I really wasn't getting into it, right? And then in the early part of 2020, those of you remember that Y2K, there was all this big fear, right? 2020, the world did not end, and the market just continued to go up, right? And this particular stock, there was a couple of stocks, right? Penny stocks, they had gone from a nickel up to $1, $5. It was up to $10. It went up to $15. It went up to $20, and then at $20, I was really paying attention. I was like, okay, maybe I need to try to get into this market. And I was seeing that even my retirement fund, right, without any effort on my own, is just the fact that I had put money into the fund that was growing, and I was like, okay, well, maybe there's something about this, right? And I remember here in Buffalo, they had a TD Ameritrade account in downtown on Main Street. So I got one of my friends. We went down there and we bought some of this stock. All right, and what was real interesting, I bought the stock in the morning. I bought the stock at $26. I bought it right here. Right, I bought it at $26. By that afternoon, right, this is what happened. Right, it started going like this, boom, boom, boom. Right, and it was just like, so I was, again, they talk about trading in the market, the idea of the greater fool theory, right? Well, in that first experience of me trading in the market and inviting a friend to trade, and again, remember, this is this is not financial advice. This is literacy. This is economic and financial literacy. But now that I look back on it, what actually happened, right? What actually happened was that the market was going up through the late 1990s. Right, and then people were getting in, and then there was this fear of missing out, and then people who was totally ignorant, right, which I was, right, totally ignorant, got into the market, and we were the ones left holding the bag, right, that's what happened, right, we were left holding the bag, and the market went down, and then I was trying to get out of the market. And it was just crazy. But what I decided is that I'm never going to let that happen again. And that's when I started studying technical analysis. Started teaching it at Buffalo State University. And I've been at this for 2 decades now. Okay. So, but what I do see happening, and I've seen it happen in 2008. I saw it happen in 2020. I saw it happen in 2011, right? That again, there's this accumulation phase, right? And then you have more people getting in this phase here. And then the greater fool, right? It was that last phase, and then it collapsed, right? So pretty much, like if those of you are paying attention to Bitcoin, right? During that time period, Bitcoin went from about $3,000 all the way up to about $60,000. Right, and then again, that's what it was, $60,000, and the $60,000 reversed, and it reversed all the way back to 16. Now, that being said, that was the bull market, accumulation phase, right, the retail phase, and then finally this last phase, the phase of excess, and that's the bull market. Now, the same thing happens in reverse, right? So if we think about what happened so let me just kind of erase this, right? But again, the way you see a trend, right? Now this is an uptrend, so you have uptrends, you have downtrends, and you have sideways trends. This is an uptrend. What we call this uptrend, we call it a bull market. And if you think about a bull, right? Like this right here, the bull is young, a very healthy bull, right? If you think of a bull in the China market, like they charge, right? One of the things that they talk about is that the market, the bull market goes up the stairs, boom, and then it goes out the window, or down the escalator, or down the elevator, right? So the bull market goes up the stairs, kind of gradually, a few days, few months, few years, and then also notice, right? I just want to make sure you understand that along these primary trends, right? You have the secondary trends, so you get stuff like this, right? You get these trends here, right? This is going on here, right? And then you get these micro trends, right? So this is what's going on. So you get these small trends, right? So you get small trends, so like what Charles Dow was looking at is he's looking at the primary trend, right? And then he looked at the secondary trend and the tertiary trend, right? The micro trends, and that's on the way up. Okay. So any questions out there? Any questions with regard to this uptrend? The uptrend is higher lows. This is a low. This low is higher than that low. This low is higher than that low. This low is higher than that low. And this right here. This is the bull market is established. Right, now it's confirmed, right, and then it gets confirmed, okay, and then you reach a height, and then whatever. You could have macro influences, like for example, what happened with us, right? In this last, we were having throughout after the pandemic, right? You had, actually for a good part of since like 2008, significant amount of quantitative easing, right? And then we had in the last year and a half, right? We had quantitative tightening. So the Federal Reserve Bank was tightening up the economy with the help of the federal government, right? And the way they tightened it up, they ratcheted up the interest rate. And one of the concepts is they like, don't fight the Fed, right? So when the Fed is tightening up the market, generally, right, that is what's leading, not by itself, right? Again, there's a whole host of factors, and this is important. So this right here, and also let me just say, let me add this, right? Because I didn't talk about the volume, right? But let's add the volume piece here, right? And we'll call that VOL, right? So volume, right? Let's say this is average. This is the average volume, right? So in a accumulation phase, right, volume might go significantly above average, right? Then you might have lower volume. Then you have above average volume. Right, volume will go up, and then you get this different volume. So volume goes up, right, and this is your average volume. So what you really want to pay attention to when you're practicing this idea of technical analysis, right, you're looking at both the price movement, right, the accumulation, when the retailers getting in, and then the excess phase, right. But you also want to look at volume, right. If there's a lot of activity when the market's going up, then that shows some strength. If it's going up and there's not a lot of volume, you might want to pay attention to that. Okay, so that's the general idea there. So that's the idea of a bull market. Higher lows, higher highs. The higher lows are more important, right? There's generally three major, now we had a bull market from 2009 to the pretty much close to the pandemic, right? That was 11 years. That was unprecedented, right? A lot of bull markets, they last about 5 years. Bear markets might last about a year and a half. But we had this huge bull market. And then we had that flash bear market during the pandemic. But then from November of 2021, the market has been relatively in a bear environment. Okay. So we could consider this like from 2020 up to November of 2021, right? And let's take a look.
Dr. Lewis on it, we can bring him in as a guest so he can share something.
Okay.
See if we can pull that out.
Okay.
Invite us in.
All right.
I keep going.
Yes, sir. All right. So that was the story of a bull market. And again, we're looking at stocks. So now the bear market, right, is going in the opposite direction, right? So you're going here, 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 and it's going down in that direction, right? And so here your bear market starts, right? Now you get lower lows. So if you look here, like again, the most obvious, it happened to Tesla, right? It happened to, a lot of those high flyers of the last bull market, they came down real hard, but they don't come down like straight down. They don't come straight down like this, right? But they come down. The slope is a lot steeper than the bull market. So again, they say the bull market goes up the stairs like this, right? The bear market goes out the window, but it doesn't go out the window like that. It goes out the window like this. Okay, so here, you got the excess phase, and again, now who is selling up here, right? It's the professionals, right? So again, it's the greater fool theory. So people who are buying at this point, right? They're the ones who have no real knowledge of what's going on in the market. They, you hear, you've been hearing this term called FOMO, fear of missing out, right? So in this situation here, you had fear of missing out. And it was the greater fool theory, right? So in my situation, when I bought at $26, right, I was the greater fool, right? I was the last one holding the bag, right? You know, like I said, I don't want to do that again. So now we have the bear market, right? And if you think about a bear, right? Right?
Got Dr. Lewis online.
Okay, Dr. Lewis, how you doing, sir?
I'm doing well. How's everyone doing today?
Oh, we're amazing, amazing. It's an amazing day. So you got a question, you got a statement, or you want to share some knowledge?
I'm just honored to be invited. I know I got some invite just to jump on here. The only statement I want to make is I'm just really interested to see how the market looks after tomorrow.
Oh, like after the Fed announcements and the price announcements, correct?
Right. Just seeing where that's going to position everyone.
Okay. All right. So I might talk about that. We'll talk a little bit before I get off. I might talk a little bit about current events. But thank you for sharing. Like what again? This is literacy. We're trying to, well, you know, like the knowledge. We got to share the knowledge, right? So I'm here. I'm sharing the knowledge. You know, it's really important that working class Americans. You know, we're not in the 20th century anymore, right? In the 20th century, you know, if you were a part of the industrial class, right? If you're part of that industrial class, right? 20th century, the social contract between the employer and the employee was that you would have a pension, and you know your job would be to work hard, show up on time, and do your job. And the pension fund managers, they'll take care of the pension. But the pensions has gone. They gone away as the dinosaur, right? And so in the 21st century, we got to take a lot more responsibility for our own finances, our personal finances in particular. What do you think, sir? Would you agree?
I agree 110%. And to that point, I think we really have to be more informed as a people, because I think that's the reservation that we see with a lot of people, especially things as simple as, if you start your 401k, your employer will match it, right? There's people that have reservations because they have no clue what that even means. And to people that's, somewhat experienced, it's like a no-brainer to us, I think.
Okay. Yeah. So that's correct. So what?
That awareness and break it down. I won't use Grant Cardone's terms. I know he has some fire for saying something like, I talk to them in street terms or street talk, right? We won't do that, but break it down so it's palatable. Because when it's not palatable, it's over people's head. When information is over people's head, there's fear involved, and they just don't make those moves that they should
Right.
or could,
Right.
to advance their future.
Well, I mean, so one thing about breaking it down, right, that I think that, and this is important, and that's actually, I appreciate that, because that's a great plug for the Academy, right? Because really, the best way to break it down, right, well, you could probably imagine, I know what it was for me, when I actually experienced buying at $26 and the stock crashed, that experience, I'll never forget that experience, right? But then if you think about the cone of learning, right? What's the worst form of education? It's kind of like what we're doing right here. I'm lecturing, I'm putting it on the board. The best form of education, second, after experience, is through skits, right? You're playing the games. So in terms of our curriculum, so if you want to get in contact, if you want to do some of the workshops that we do here, the best way to learn, it's kind of like play Monopoly, right? If you play the Monopoly game, right, it's a game form, you learn, and all that stress, all that fear kind of disappears while you're playing Monopoly. Like I also played, I don't know, Doctor, have you played the cash flow game before?
No, I haven't.
Have you heard of it?
No.
Okay, so again, it's a game. So in my classes, right, and here at the Academy, what we do is when we bring people around, we play games, right? And the game it's the game of it's a personal finance game. And we learn how to take earned income. We play a skit. You have a particular profession. You learn how to fill out the numbers on from your profession. You fill out a financial statement, and then you fill out income, expenses, assets, and liabilities. And then we talk about, right, what are the consequences, what are the 20-year or 40-year consequences of having the financial habits of the poor? What are the 20, 30, 40 years consequences of having the financial habits of the middle income class? Or what are the 20, 30, 40 year consequences of having the financial habits of the rich? So this conversation that's going on right now, this is filling up the toolbox, right, so that you could practice the financial habits of the rich. And really, what we really have to understand, if you build up the habit of even saving a quarter a day, right, or a dollar a week, right, the habit, right, and you put that into your asset column in the form of savings, and then figure out how to convert from savings to an investment, that habit is what is going to change your life over a 1 year, 5 year, 10 year, 20 year, or a lifetime. We call it from 20 to 70, your golden years. Like, what are you going to do with your golden years? So this story here, right, this analysis is going to be critical to determine, right, because you don't want to spend your whole life, 50 years, to have a pay cut and live at a relatively subsistent level of existence when you're 70 years old, right? So we want to really hit up the young folks and tell these young folks, like, no, pay attention now, right? You got people who care for you, the people we at the Academy who care for you. We want to share our knowledge with you. We're gonna break this down into short form, in digestible pieces. And what you do is you study the basics over and over and over again. Do the basics. Okay? All right, so we good? Okay.
Thank you, Dr. Lewis, for joining us.
Yeah, thank you, Dr. Lewis. Appreciate you.
And truly a pleasure. Thank you for having me. Keep up the great work, guys.
Thank you. Okay, so we're down at the last 6 minutes. So the real quick, Investor Business Daily says that we're still in a confirmed uptrend. The uptrend started in the beginning, I believe we had an uptrend in January. We had a correction in probably early March, but we're back again, confirmed uptrend, right? So I'm not really going to talk about that. Next time we will talk a little bit more about current events. But real quick, let me tell you, right? So again, Bitcoin, and next Monday will be Crypto Monday, and at 7 o'clock we will be talking about cryptocurrencies, Bitcoin in particular. So check us out next Monday. You could get in contact. You'll find information about it at Dr. C. Haynes Jr. at all social media. So check us out on that, right? But Bitcoin dropped from about 60,000 down to about 16,000, a 70% correction. However, from January 1st to today, Bitcoin has had close to a 90% growth, right? It has outperformed all asset classes in 2023. So pay attention, okay? So to close up, right, I spent a lot of time talking about the bull market, but the bear market, again, this is the excess phase, right? And then what happens, and actually I'm going to get rid of this last piece right here. Let's just go 3 parts right here, right? People like get out of the market, excess phase. The professionals right here, they get out of the market. Retail people get out of the market. And here, this is what they call capitulation, right? This is when it's like, look, you got so much pain, right? It's like, you don't want to play anymore. So you just, if you had some stocks, you sell. And again, those people who are playing the game, the people who make the markets, they'll take that pain off your hand, and they'll buy the stocks from you at a discount, and then they make the game happen all over again. And then this is what happens, right? Then it goes up again, and it moves in that direction. Okay, so Bear market, lower lows, right? Lower highs, right? Different players. Those who started the game, they sell those. Remember, they bought those stocks way at the bottom of the bull market. They sell their last amount of stocks to the foolish people at the end. Right now, they're buying it back, right? And then this will be when the retail person capitulates, right? The professionals are buying up all those shares at discounted prices, and they start the game all over again. All right, so that's it for today. So in summary, what we talked about was, again, I introduced the reason this is significant. Let's go back to the PowerPoint presentation. Okay. Okay, so the reason this is significant is, right, this is you, this is me. Working class people, right, we tend to have the financial habits of the poor, where we have money coming in and money going out. Middle income class, or the middle class, right, who live in the American dream, and they discover in horrific bear markets that the American dream can turn into an American nightmare. And like they discover, like for example, their house. They think that their house is their number one asset, but when you lose your job, you find out who actually owns that house, right? When the bank or the city forecloses on that property, right? So what we want to teach is this financial habit here, right? Where whether you make $10,000 a year, $50,000 a year, $100,000 a year, $200,000 a year in the form of earned income, you have one source of income. We want you to pay attention to have multiple sources of income. Like in this example right here, property, intellectual property, banknotes, bonds, stocks, and real estate. Technical analysis is really focusing on, is one of the tools in your toolbox. So if you think you're building a house, you're not going to build a house just with a hammer. You're going to build a house with a hammer, a lever, right? A saw, right? Nails. You're just going to have all this equipment in your toolbox. Technical analysis of financial markets is one of the tools that you will have, that we suggest that you have in the toolbox. So, thank you for spending time with us. Again, this is Dr. Curtis Haynes Jr. You could get in contact with me or follow me. And also subscribe at my social media, right? Subscribe at any of our social media, Dr. C. Haynes Jr. at any social media. I've been really now I also want to say this. We're really talking about a paradigm shift. So if you could follow me on Twitter, right? I've been really putting some interesting material on Twitter. So make sure you follow us on youtube.com/@Sigla_Buffalo, right? Again, make sure you follow us on youtube.com/@Sigla_Buffalo. So check us out. We're here. We're here for you. We want to share the knowledge. If you have any questions, drop it in the chat. Contact us through our social media, and we'll be with you. Okay? All right. I think we're out of here.